is it risky, and what are the issues you should be taking care of? I have somebody who has looked at small cap, mid cap section very closely and is joining us after a while today. Jigar Mistry of Buoyant Capital is here with us. Jigar, uh, if you look at, just for the reference sake, today's screen, large caps are pretty quiet, but that has been the story for last few weeks now. How are you analyzing the construct of the market right now?
Hello, Jaya. Good afternoon. Pleasure to be on your show again. See, it is interesting time because if you look at India from a slightly longer term perspective, it looks like that you are going to have not just fundamentals which are reasonably good, but it will eventually end up attracting a lot of flows as well. A lot of investors, I think, are now taking that to mean that because the long term is great, the run up to the long term still needs to be great. And a vast section of the retail investors in India have started after COVID, and then they sadly have not really seen any down cycles so far. So I think the way in which we are approaching this is that if you look at sort of the ownership spectrum of large cap versus small caps, and look at the free float as an additional sort of variable into this, very interesting data is sort of shaping up. I think there's a few sort of graphics that is running there. But if you look at the free float ownership in the large caps, FIs are the predominant sort of investors with almost 42% of the ownership in free float large caps. But if you look at retail, you look at small caps, retail ends up owning 49%. Now, the rally that has begun from March this year, a lot of businesses, I think 150 plus businesses have more than doubled in share price. And then you analyze that on a sort of sub basis, you will find that lower the free float, the extent of gains are higher. Smaller the market cap, the extent of free float is higher. And then when you sort of superimpose what really happened in the 2018-19 cycle, things become sort of rather questionable. So as we speak, if we take 25% of a drawdown as a particular pullback or start of a new cycle, then arguably we are in the second best small cap rally since the start of the equities investing in India. So our sense is that a large part of sort of play out has happened. One needs to keep an eye out. Now, allow me a minute to run you through what happened in 2018-19. Correct, in 2018, you're coming off 2016-17 sort of small, strong gains in the small caps. And after that, I think the long-term capital gains was introduced in the budget of 2018. And then later that year, the categorization of mutual funds to stick to true to label had come through. Now, those two individual changes in and of itself should not have resulted in a huge sort of pullback, but it did. So, profits during that same period kept on rising. In fact, in those 2 years, it rose almost 40%. But the index, the BSE small cap index, fell 38% during that time. And there were 250 companies which fell more than 60%, and 50 companies fell more than 80% during that time. So I think while the going is great and there are still a lot of quality businesses that are up there, we need to keep an eye out on what's really happening in the sort of small cap. As a sector, it's still good, some interesting businesses, but I think this plain vanilla, broad brush to paint everything looks a little bit questionable.
So, what does your portfolio look like right now? Talk to us about, say, top three biggest weights in your portfolio right now.
See, I'll run you through, Ajay, the sort of change that we have had and then the sectoral ownerships. Clearly, by March 2023, we were 60% small and mid cap as a fund, right? You remember in March, there were budget changes, and I think a lot of investors were busy investing into fixed debt products and buying a lot of insurance, and therefore, some mid caps, because of low liquidity, were available at very attractive valuations. So that's where we had turned dramatically into small and mid caps. And if I look at our October portfolio, then I think that proportion has fallen below 40%. We operate into this aggressive and sort of defensive mindset where we bring down the portfolio weights to 30% if things sort of go into the other direction. So there is still some leeway, but we are using this current rally to shift more into large caps and cap and sort of taking time to fully deploy the new cash that we are getting. In terms of sectoral allocations, I think given where sort of banking financials is in India, I think that's one space which has the highest space in our portfolio as well. But incrementally, insurance, cement, pharma is a space where we are finding a lot of value as we go.
In pharma, talk to us about what have you picked up and the rationale over there, because it's very stock specific call in pharma, right?
Well, yes, Ajay. So stock specifics for sure, but if you look at what led to the correction, so I'm taking sort of maybe a step back, and you go to sort of what allowed Ranbaxy to launch the sort of Lipitor generic or announce the Lipitor generic in 2002. It got launched much later. I think that rally played out until 14, 15, after which all the ingredients that led to such a strong rally had, started withering down. So India traditionally has been a great sort of single molecule manufacturer, or rather reverse engineer. And that way we were doing fairly good. But all the patent cliffs that happened after that were either complex molecules or complex generics and multi-molecule sort of ingredients. And that's where India did not do very well. Secondly, the GADUFA sort of framework that came through that not only raised the fees for a lot of people, but the R&D budgets for many companies kept going up. And after that, I think the inspections that fell through, a lot of companies in India were sort of found wanting is an understatement. So I think all these ingredients, and last point, in fact, I should mention is that how the PBMs essentially sort of merged together and the purchasing power got a lot more potent. At the margin, I think, and after that, I think Teva sort of Lupin here sort of fell dramatically. And post that, I think we are sensing, so rather we were in April sensing the first rounds of turnarounds where the generic pricing in the US were not falling as much as they used to. And things since then, the things were looking like great. So there were businesses, we wrote an article in April saying that this is where we find a lot of value. And I think if you rank down the generic, we did give out an order that Oro, sort of Alembic, Zydus, all those appear to be a reasonably well-positioned businesses if there was a turnaround in the US. So as you said, stock specific, yes, but at a more generic level, it looks like the worst of the pains as far as generic pricing is concerned is behind us.
Fair point. Jigar, what are the latest additions or changes which you've made, deletions in your portfolio in the last 3-4 months?
Sort of at the webinar we put out in November, we highlighted the 3 businesses that we have added. One clearly was ICICI GI. So that's where we have increased weights in a meaningful manner. And the other 2 were small and mid-cap businesses. One was RR Kabel and the other was Aavas Financiers.
Okay, I get it. What are the risks you are looking at and are also building in your portfolio just to be prudent in risk management wise right now?
So one of the major issues, that we are grappling with, Ajay, is how, high US interest rates and higher for longer interest rates are 2 separate things. And I don't think the market is very, very well appreciative of that just yet. See, when you have the interest rates go up and then come down immediately, we don't see a full transmission in the system. For example, the mortgage rates in the US at the marginal level is upwards of 7.5 percentage points. But if you look at the lock-ins that were set up 2 years back or so, the average mortgage payer is still not paying upwards of 3 percentage points. So if the rates stay higher for longer, then you are likely to see that reset coming through, which will impact sort of the companies and the earnings at the CRB level, so the commercial and real estate business level. Secondly, post-COVID, you are seeing a lot of cash flows being put out to the individuals and businesses by the US government. And the cash levels, if you see, have only been normalized now. So if these rates stay higher for longer, then what most of us believe or used to believe that rate hikes have happened, whatever worst is now behind us, it's in the price, then that may not end up being true. That is as far as the US is concerned. As far as India is concerned, I think the biggest challenges continue to remain at the current account and BOP level. Crude settling down lower below 80 is great news. But if I don't know if you have checked recently, there has been a dramatic drop in the net FDI levels, right? Gross FDI was still chugging along reasonably well, but with the spate of sell-offs that have happened, the net FDI is come down to a below $5 billion now. Last quarter it was in excess of 30. Now, and the last point here is that there is a lot of resettlement of the short-term maturities that needs to happen, upwards of $250 billion in the next 9 months. So if you can have the cocktail of events where oil moves up to $90 and net FDI stays low, you might have a pressure on the sort of RBI to act, completely distinct for where the central banks across the world are acting. So I think that remains one of the challenges. Secondly, challenges with regards to some valuation concerns do remain. I think a lot of investors are not waiting for the proof of the pudding. See, with a lot of huge increase in order backlogs that we are seeing with some of these businesses, I would want to see if that translates into higher earnings eventually. Because order backlog driven stock price movements are great, but unless companies can deliver on the OPM, the operating profit margin, or the PAT level, it ends up becoming more of a drag than a gain. So I think those proof of the pudding concepts needs to be proven before we go up on the next leg in the small and mid cap space. Other than that, I think state elections are not really a big challenge. I think enough and more has been said. How the share percentages at the local assembly versus the general elections tend to change, and therefore policy construction needs to will more or less remain. So those are not really great risk elements, but these are at the broader macro level, and the valuation level is what we are watching out for.
Right, excellent. All right, Jigar, we'll let you go on that one. Thanks so much for joining us on the show today. That
Thank you.
was Jigar Mistry.